Alright, today we're gonna decode what I like to call the secret language of the market. Japanese candlesticks. And I want you to forget about seeing them as just these complex, intimidating charts. Instead, think of them as the visual language of market psychology. A story of fear, greed, and indecision, all told in simple shapes and colors. You know, every single shape, every wick, and every colored bar on here tells a chapter in this constant battle between buyers and sellers. By the end of this, I promise, you won't just see a chart anymore. You'll actually be able to read the story the market is trying to tell you. So here's our game plan. We're going to start with the absolute basics, the single building block, one candle. From there, we'll look at bullish and bearish signals, uncover those moments of market indecision, and then we'll wrap up with what is, without a doubt, the most important rule of all, why context is king. Okay, let's dive right in. Look, before you can read the whole story, you've got to learn the alphabet, right? Well, for price charts, that alphabet begins with understanding one single candlestick. If you can master this, everything else will just fall into place. So what exactly is a Japanese candlestick? Well, think of each candle as a complete story of a single trading session. Doesn't matter if it's 1 minute, 1 day, or a whole week. It packs 4 absolutely essential pieces of information. The price when it opened, the absolute high and low points it hit, and where it finally closed. And here's the really cool part. With just a single glance, the color tells you who won that session's battle. If it's green, the bulls, the buyers, pushed the price up and came out on top. If it's red, the bears, the sellers, dragged it down and took control. It's really that simple. Now, every candle has 2 main parts. You've got the thick part, that's the body, and it shows you the core battleground between the open and close price. A big long body means one side won and they won decisively. Then you have the thin lines, the wicks. They show the extremes of the fight. Think of a long wick as the market testing a price level and getting slapped right back down. Okay, so now that you get what one single candle's all about, let's see how they combine to form patterns. We'll start with the good stuff, the bullish signals. These are the clues that suggest buyers are starting to really take control of the market. And first up, we've got a classic pattern, the hammer. Its shape is pretty unmistakable, just like its name suggests, and when you see it after a price decline, it can signal a major turning point, like the market is literally hammering out a bottom. So here's the story the hammer is telling you. The sellers try their best to keep pushing the price down. That's what that long, lower wick represents, but they failed. The buyers stormed in with so much force that they drove the price all the way back up. It's a textbook signal that the sellers are getting exhausted. Next up is a really powerful 2-candle pattern, the bullish engulfing. Now, this isn't just a small shift in momentum we're talking about. This pattern can signify a potential tidal wave of buying pressure coming into the market. What makes this pattern so incredibly significant is how that second green candle completely overtakes, or, engulfs, the previous day's red candle. It's like a visual knockout punch, showing a really sudden and decisive shift from selling to buying. Alright, so just as there are signals for a potential rally, there are also patterns that act as warning signs, telling us a price climb might be running out of gas. These are the bearish signals, and they show up when sellers are starting to win the fight. The bearish cousin of the hammer is the shooting star. It has a pretty similar shape, just flipped upside down. But the key here is its location. It appears at the top of an uptrend, and it can signal a potential peak in the price. The story here is really one of overconfidence. The buyers try to push the price even higher and higher. That's what creates that long upper wick. But they reach just a little too far, and the sellers step in and forcefully slam those higher prices right back down. It's a huge warning sign that the buyers might be losing their grip. And yep, you guessed it, just like its bullish counterpart, the bearish engulfing pattern is a powerful 2-candle warning. This time, though, it signals that the sellers are coming out in full force, ready to take over the market. This pattern shows a super dramatic reversal. The buying momentum you saw in that first little green candle doesn't just stop. It gets completely overwhelmed and erased by the sellers in the second candle. It's a very clear signal that the market sentiment has flipped and sellers have seized control. So sometimes, the market isn't clearly bullish or bearish. Sometimes, it's just confused. There's this intense tug-of-war going on where neither side can get the upper hand, and these indecision candles show us that the market is just taking a moment to pause and think. And this little guy is the doji, because the open and close prices are almost exactly the same. Its body is just a tiny, thin line. It represents a perfect stalemate, a moment of equilibrium where a fierce battle between buyers and sellers just ended in a flat-out tie for the session. But here's the thing. Not all stalemates are created equal. These two variations, the dragonfly and the gravestone, actually tell us who is losing strength. The T-shaped dragonfly shows that sellers tried to push prices down but failed. The upside-down gravestone tells the opposite story. Buyers tried to push prices up and were defeated. Both signal indecision, but with a huge clue about who's running out of steam. Okay, everybody listen up, because this is probably the single most important lesson we're going to cover. Seriously, memorizing patterns is easy, but understanding where they matter, that's the real skill. A pattern is only as good as where you find it. You have to remember this. Candlesticks are not a crystal ball. They are a tool for judging probabilities. A perfect-looking hammer pattern that just pops up in a random part of the chart, that's usually just noise. Its true power, its real meaning, comes from its location. So, this brings us to a super simple but incredibly powerful three-step framework. First, you identify the pattern. Second, and this is the absolute key, you check its location. Is it happening at a price level where the market has reversed before, like a key support or resistance zone? That's where these signals become super reliable. And finally, you wait for the next candle to confirm that the story is actually playing out. So let's bring it all home. What have we learned? Well, every single candle tells a story about the market psychology. Bullish patterns show buyers are taking over. Bearish patterns show sellers are getting the upper hand. And dojis show indecision. But the biggest thing I want you to walk away with is this. A pattern alone is just a hint. A pattern at a key location with confirmation, well, that's a powerful high probability signal. So from now on, when you pull up a price chart, don't just see a bunch of lines and colors. Ask yourself, who's in control right now? Who's losing steam? What is the story that the market is telling you right now? That right there is the... Alright, let's talk about gold. You've probably heard about it, seen the headlines, and maybe you're wondering how to get started trading it. Well, you're in the right place. Today, we are putting together a complete blueprint for tackling one of the most exciting and, yeah, one of the most challenging markets out there. Gold or XAUUSD. This is your guide. So, here's our game plan. First, we're going to get a feel for the arena, the world of gold trading itself. Then we'll get our hands dirty and build your technical toolkit. After that, and this is absolutely critical, we'll talk about the rules of risk. From there, we'll dive into mastering your own trading psychology. And then finally, we'll put all the pieces together into your very own blueprint for consistency. Sound good? Let's jump in. Okay, first things first, we have to understand the playing field. Before you even look at a single chart or think about a strategy, you've got to understand what actually makes gold move. Why do so many people trade it? And what are the real risks hiding just below the surface? So seriously, what's the big deal with gold? I mean, for thousands of years, it's been a symbol of wealth. But today, it's so much more than that. It's a major player on the global financial stage, and it attracts everyone from giant central banks all the way down to retail traders like you and me. So what is it about this shiny metal that gets so much attention? Well, here you have it, the two sides of the coin. On one hand, gold is seen as a safe haven. You know, it's a place to park money when inflation is high or the world gets a little crazy. And it's super liquid, so it's easy to get in and out of trades. But here's the flip side. That same popularity means it can be incredibly volatile. It doesn't pay you anything just to hold it, and its price can swing wildly because of a single political headline. It's this exact tension between being a safe asset and a risky one that creates all the trading opportunities. Alright, now that we know what we're dealing with, it's time to build out our toolkit. In this section, we're going to focus on two fundamental tools that technical traders use to read the charts and really make sense of what gold's price is doing. Our first tool is the moving average. The best way to think about it is as a noise-canceling filter for the market. If you just look at a price chart, it can look super chaotic from one minute to the next. The moving average smooths all of that out by giving you the average price over a specific period. It just gives you a much cleaner view of the real underlying trend. And here's a really simple but powerful way to use them, the MAC crossover. You put two moving averages on your chart, a fast one that reacts quickly to recent prices and a slow one that shows the longer-term trend. When that fast line crosses up and over the slow one, it can be a signal that upward momentum is building. And when it crosses down below the slow one, it might be telling you the trend is shifting bearish. It's a clean visual signal. Okay, tool number 2 is Fibonacci retracements. Look, markets don't just shoot up or down in a straight line, right? They move in waves. There's a big move up, then a little pullback, then the move continues. This tool helps us predict where those pullbacks might end, giving us potential spots to join the trend. Now, let's be clear, there's no magic behind these numbers. Their real power comes from one simple fact. Millions of traders all over the world are watching these exact same levels. It becomes a kind of self-fulfilling prophecy. Because so many people are looking to buy or sell at these zones, that's often where the price will react. That 61.8% level, the golden ratio, is a huge one. A lot of traders watch that as the ideal spot for a trend to turn back around. Okay, stop. Before we go any further, we need to talk about the single most important part of this entire blueprint. I'm serious. You can have the best strategy in the world, but without this, you won't last. We need to build your shield. Risk management is what keeps you in the game long enough to actually win. I want you to burn this number into your brain. 1%. This is your ironclad rule. By risking only 1%, a tiny fraction of your trading account on any single trade, you make it almost impossible to blow up. Think about it. You could be wrong 10, even 15 times in a row, and you would still be in the game. Trading is a marathon, not a sprint. This rule ensures you can finish the race. And this simple little formula right here is how you do it. This is your personal risk manager. It takes all the emotion and guesswork out of how much to trade. First, you calculate your account risk, that's 1% in dollars. Then you figure out where your stop loss needs to go based on the chart. You plug those two numbers in, and it tells you exactly what your position size should be. No exceptions, no gut feelings. And this is exactly why this is non-negotiable for gold. As we said, gold can move fast. A news announcement can send it flying. Without this shield, that volatility is a terrifying threat. But with disciplined risk management, that same volatility is just an opportunity that you are prepared to handle. So you've got the tools, you've got the shield, but there's one last enemy you have to face. And it's the toughest one of all, yourself. Seriously, the real battle in trading is fought between your ears. Taming that inner beast is the final piece of the puzzle. And these are the big ones. We've all felt them. There's FOMO, the fear of missing out, that voice that screams at you to jump into a trade after it's already taken off. There's revenge trading, when you take a loss and immediately jump back in with a bigger size to get your money back. There's greed, which whispers that you should cancel your profit target and let it run. And then there's fear, which makes you snatch a small profit way too early on a great trade. The only way to beat these is with a concrete, predefined plan. This really says it all. You could give two traders the exact same winning strategy. The one who has mastered their emotions will make money. The other one won't. It's that simple. Your success over the long run is a direct reflection of your mental discipline. So how do you do it? You create hard and fast rules that act like circuit breakers for your emotions. A rule like stop trading after 2 straight losses prevents a bad day from becoming a catastrophic one. A rule like never ever move your stop loss further away prevents a small acceptable loss from turning into a disaster. These rules are not there to limit you. They are there to protect you from yourself when you're most vulnerable. Okay, this is it. It's time to bring everything we've talked about together. We've looked at the market, we've built the toolkit, we've crafted the shield, and we've started to tame the mind. Now we put it all together into one master plan that will guide every single trade you ever take. Your trading plan is your business plan, and it needs to be written down. You need to define exactly what your entry signal looks like, where your exit goes, your maximum risk per trade, and your maximum loss for the day. You decide all of this when you're calm and rational before you're in the heat of the moment. And if the plan is your blueprint, then your journal is your progress report. This is how you actually get better. You don't just track your profits and losses. You track why you took the trade. What were you thinking? What were you feeling? Were you disciplined? Were you scared? This is where you become your own coach, and it's where you turn your weaknesses into your greatest strengths. And that's it, a complete blueprint for how to approach the gold market with structure, with discipline, and with a plan. It's not an easy path, but it is a clear one. You have the tools, you have the blueprint. So the only question left to ask is, what are you going to build? Okay, so let's just dive right in. We all see candlesticks on our charts, right? Every single day. They're supposed to be this amazing tool to predict the market. But let's be honest, for a lot of traders, they just lead to confusion and a whole lot of losing trades. Well, today, we're going to fix that. We're going to talk about how to actually read them the right way. What if I told you everything you know about candlestick patterns is a lie? I mean, that's a pretty bold statement, isn't it? Hammers, dojis, those famous engulfing patterns. The problem is, the way most people use them is just completely wrong. They treat them like these little magic signals that are supposed to print money. But that's not how this works. We have to go deeper. You know, the biggest myth out there is that these patterns are like cheat codes in a video game. You spot a bullish engulfing candle, you blindly hit buy, and then you just watch in horror as the price goes the other way. The reality, each and every candle is a word, and when you put them together, they form a sentence, a story. So our job isn't just to be a pattern spotter, it's to actually read the story the market is trying to tell us. So how do we learn to read this story? Well, like any new language, you start with the alphabet. And the good news is, the entire language of the market is written with just 3 core types of candles. Seriously, that's it. Once you master these 3, everything else just clicks into place. First step, we've got the most powerful one of them all, the strength candle. This is your sign of pure unfiltered conviction. When you see a big full body with tiny little wicks, it's telling you that one side, either the buyers or the sellers, is completely dominating. There's no argument, no fight, it's a statement of absolute control. And believe me, with these strength candles, size absolutely matters. A small little body shows a bit of control, sure, but a massive chart-dominating candle, that's a shout, not a whisper. It's a clear message of overwhelming, undisputed power. The larger the body, the more in control that side is. Next up is the control shift candle. You might have also heard it called a reversal candle. Now, the key to this one is that long, pointy wick. That wick is like a fossil record of a failed attack. It shows you exactly where one side tried to push the price, but the other side came in and just slammed the door shut, completely taking over. This is where you can spot a potential change in momentum. And finally, we have the indecision candle, which a lot of people know as a doji. Think of this as the market hitting the pause button. You've got a small body and wicks on both sides. It's basically a perfect tug of war where buyers and sellers fought to a complete standstill. No one won. Now, this candle by itself doesn't tell you where the price is headed, but it's a huge warning sign that a big move could be just around the corner. And this brings us to the most important point of this entire explainer. You never, ever trade based on a single candle in isolation. It just doesn't work. The real magic happens when you start combining them, when you start putting the words together to understand the full context of the story. And the process for reading this story is actually pretty simple. It breaks down into 3 steps. First, you spot the indecision. That's the battle, the tug of war. Second, you wait patiently for the confirmation, a big strength candle or control shift candle that tells you who won the battle. And only then, once you know who's in control, do you move to step 3 and start planning your entry. Alright, enough with the theory. Let's see how this actually works on a real live chart. We're going to go through this together and read the story of the market, candle by candle, exactly as it unfolds. Okay, so here we go. We can see the price has been moving down, but then look closely right here. What do we see? 3 indecision candles all in a row. The market is hesitating, it's hitting the brakes. And notice that one of them has that long lower wick. That's a little clue that buyers are starting to wake up and push back from below. And then, what happens next? Boom! Right after all that hesitation, we get this massive green strength candle. This is our confirmation. The indecision was the question, and this huge candle is the answer. The buyers have won the fight, and they didn't just win, they won decisively. Now, this brings us to a really crucial concept, speed. Check this out. It took sellers 22 candles to push the price down to this level. But how long did it take the buyers to reclaim all of that territory? Just 4. 4 candles. I mean, what does that tell you? It wasn't even a fair fight. The buyers are way more aggressive and way more powerful in this moment. So because that powerful, speedy move started right here, we can actually mark this zone on our chart. We're going to call it an area of demand. Why? Because it's an area where we know, for a fact, a huge number of buyers showed up with a lot of money. We should fully expect them to defend this area if the price ever comes back to it. So the price moves up from our demand zone, but then the sellers decide to fight back. We see a red control shift candle with that long upper wick. That's a failed push by the buyers, and it's followed by a red strength candle. While this creates the exact opposite of our demand zone, an area of supply, it's a place where sellers have proven they are in control. Okay, so let's just pause and recap the story we've read so far. We know the buyers showed incredible strength and speed. Now sellers are pushing the price back down, but look how they're doing it. Much more slowly, right? And where is the price headed? Directly back towards our area of demand, the exact spot where we already know the buyers are waiting. And here it is, the key moment. As soon as the price taps into our area of demand, sellers try to push through. But look what happens. They get rejected, forming a green control shift candle. And what comes right after? A green strength candle. That's our confirmation. The buyers are back in full control, defending their territory exactly like we thought they would. Now that we have this clear confirmation, our trade plan basically writes itself. We can look for an entry on a little pullback to our confirmation candles. Our stop loss, that goes safely below the entire area of demand, giving us plenty of protection. And our take profit target. The most illogical place is that area of supply we identified earlier, where we know sellers are likely waiting. And just like we read in the story, the plan plays out perfectly. Price moves up from our entry point and hits our take profit target right at the area of supply. This wasn't guesswork, it wasn't magic, it was simply about reading the narrative the candles gave us and then acting on it. So this all really comes down to one new golden rule. It's a fundamental shift in how you need to look at your charts from now on. Here it is. You should never ever enter a trade based on just a single candle. A single candle is just a word. It means almost nothing without the context of the sentence in the paragraph around it. You have to stop looking for individual signals and start looking for the whole story. The difference is night and day. The old way is being a pattern spotter, just looking for isolated shapes, reacting to one candle, and well, being wrong pretty often. The new way is to become a story reader. You look for multiple correlations, you identify these zones of control, and you piece together the full narrative to find those truly high probability setups. So the next time you open your charts, I want you to ask yourself, are you just spotting random patterns, or are you ready to start reading the story? Because that simple change in perspective, well, hey everyone and welcome. Today, we're diving straight into MetaTrader 4. We're going to get super practical and walk through, step by step, exactly how to set up and manage your trade orders. My goal is to get you feeling totally confident, turning your trading ideas into real action on the platform. So let's get right to it. Are you ready to really take control of your trades? Because that's what this is all about, giving you the skills to execute your strategy with absolute precision. So let's build this from the ground up, starting with the basics. Here's how we're going to do it. First, we'll introduce the different kinds of orders you can place. Then, we'll get into the nitty-gritty of how to actually enter a trade. After that, and this is super important, we'll cover how to set your protective orders. We'll even look at managing trades once they're live, and then we'll wrap it all up with a quick summary. Okay, first things first, let's talk about the core order types. You gotta know these three because honestly, they are the foundation for absolutely everything else you're gonna do in MT4. The simplest one to start with is the market order. Just think of this as the get me in the trade right now button. When you use it, you're just telling the platform to buy or sell for you instantly at whatever the best price is at that exact moment. It's all about speed. But what if you don't like the current price? What if you want to wait for a better one? Well, that's where a pending order comes in. This thing is a game changer. It lets you set your entry price ahead of time. The trade will only get triggered if the market reaches the level you chose. You can literally set it and walk away. And these pending orders really come in two main flavors. You've got stop orders and limit orders. These are your tools for being strategic. They let you say, look, I only want to get in if the price hits this very specific point. This gives you way more control over your entries. Alright, that's enough theory for now. Let's put this into practice. We're about to walk through the exact clicks you need to make to place these different orders right inside the MT4 platform. Let's do it. For a quick market order, it's just 4 simple steps. First, you hit that new order button. Then, you double check you've got the right symbol, the currency pair you want to trade, and you set your size in the volume box. Make sure the type says instant execution, and then, boom, you click buy or sell, and you're in the market live just like that. But a lot of the real strategy in trading comes from being patient. from waiting for the price to come to you. And that's exactly what pending orders are for. So let's check out how to set up trades that will sit there and wait for your perfect entry point. To set a limit order, you start off the same way. You click New Order. But here's the key. You change the type to Pending Order. And when you do that, a whole new set of options pops up. From there, you just choose Buy Limit or Sell Limit. Type in the exact price you're waiting for and hit Place. That's it. Your order is now armed and waiting. And you know what's great? Setting a stop order is almost the exact same thing. Seriously, you follow the same steps. The only difference is that in that drop-down menu, you'll choose Buy Stop or Sell Stop instead. The process feels identical, but what it does is totally different, which actually brings us to a really crucial point. Okay, so let's make this super clear. What is the real difference? A buy limit is used when you want to buy below the current price. You're basically hoping for the price to dip down to your level so you can buy it on sale. A buy stop, on the other hand, is for buying above the current price. You're waiting for momentum to break out to the upside. And it's the exact opposite for sell orders. Getting this right is key to making sure the platform does what you want it to do. Getting into a trade is really only half the story. Now we've got to talk about getting out. So this section is all about the two most important orders for managing any trade you're in, the stop loss and the take profit. Let's start with the fun one, the take profit order. This is your automatic profit grabber. So say you buy the FTSE at 7,000 and you think it's going to 7,020. Well, you can set a take profit right there at 7,020. If the market hits your target, MT4 automatically closes the trade and locks in that profit for you, even if you're not at your computer. Now for what is arguably the most important order of all, the stop loss. This is your safety net. It automatically closes your trade at a price you decide on to stop you from losing too much money. This is your #1 risk management tool. It lets you decide exactly how much you're willing to risk on a trade before you even get in. And setting them couldn't be easier. Right in that new order window, you'll see fields for both take profit and stop loss. You can just fill them in right from the start. Or, hey, if your trade is already running, no problem. Just double-click on it in the terminal at the bottom of your screen, and you can add or change them anytime you want. So here's the big takeaway on this. It's not an either-or choice. You can, and you absolutely should, use both a stop loss and a take profit on every single trade. Doing this means you've defined your downside risk and your upside target right from the get-go. That's a complete trade plan. All right, moving right along. What happens when a trade is live? Your plan doesn't have to be carved in stone. As the market moves, MT4 gives you some really simple ways to adjust your orders on the fly. You've basically got two easy ways to do this. The first is what we just mentioned. Double-click the trade and just type in a new number. Easy enough. But the second way is, well, it's kind of fun. You can literally just go to your chart, click on the line that shows your stop loss or take profit, and just drag it to a new price level. It's super fast and visual. And using that drag and drop feature is perfect for a really common management tactic. Let's say your trade moves into a nice profit. What you can do is drag your stop loss up to the price where you first got in. We call that moving to break even. Now, the worst thing that can happen is you get stopped out with zero loss. You've essentially created a risk-free trade. Pretty cool, right? Okay, we have covered a ton of ground. So let's bring it all home and wrap up with a quick summary that you can use as your go-to checklist for placing orders in MT4. So here it is, plain and simple. Use market orders when you need speed. Use pending orders when you have a strategy. Always use a stop loss to manage your risk, and use a take profit to lock in your winnings. And don't forget, you can always adjust things easily by either double-clicking or just dragging those lines right on your chart. And I really want to leave you with this one quote about the stop loss order. It says, "This order enables traders to quantify and manage their risk." If you only remember one single thing from our time today, please let it be that. Quantify and manage your risk. So there you have it. You now have the toolkit for placing and managing orders like a pro. The only thing left to do is to actually use it. So my question for you is, which one of these order types are you going to jump on your platform and test out first? Thanks for tuning in. So, have you ever pulled up a financial chart and just felt totally lost, like you're looking at some kind of secret code? Well, you're definitely not alone. And today, we're going to demystify one of the most important tools in trading, the Japanese candlestick. And yeah, I get it. A whole screen filled with these little green and red bars can look pretty intimidating. It's a wall of data, and at first glance, it just feels like chaos. But here's the good news. It's not a secret code at all. It's actually a language, and it's surprisingly easy to learn. So in the next few minutes, we're going to break it all down, piece by piece, and show you how to read the story that these charts are telling. Okay, so first things first, what are we even looking at here? Simply put, candlestick charts are the most popular way traders visualize how the price of, well, anything, a stock, crypto, you name it, is moving over a period of time. Think of it like any other graph. The line across the bottom, that horizontal axis, that's your timeline. It could be broken up into 5-minute chunks or 1-day chunks, whatever you set it to. And the axis going up the side, that's the price. So every single one of those little candles you see tells the entire story of what the price did during that one specific time interval. Now, the real key to understanding the whole chart is to first understand just one single candle. Think of each one as its own little package of information, and every candle's made up of just two main parts. First, you've got the body. That's the thick rectangular part, the part that has all the color. This is really the main event. It tells you the core of the story, where the price started and where it ended during that time frame. And then you have the wicks. Some people call them shadows. They're the thin little lines sticking out of the top and bottom. The wicks show you the full drama of the period, the absolute highest price and the absolute lowest price the asset hit before that candle finished forming. Alright, let's talk about the most obvious thing on the chart, the color. This is your first instant clue about what's going on. Just by glancing at the color, you already know a half the story. It's super simple. If a candle is green, that's a bullish candle. It means the price went up overall. The price closed higher than where it started. Buyers were in charge for that period. And if it's red, that's a bearish candle. The price went down overall. It closed lower than where it opened. The sellers won that round. That's it. Green means up, red means down. But here's where these candles get really powerful. Every single candle, no matter its color or its shape, packs in 4 crucial pieces of information. This is what makes them so incredibly useful for traders. And these 4 data points are the open, the high, the low, and the close. You'll often hear it called OHLC. The open is the very first price when the candle's time period began. The high and low are the extremes that the wicks show us, and the close, that's the very last price right before the time period ended. So how do you spot these on the candle itself? Well, for a green candle, it's pretty logical. Since the price went up, it had to open at the bottom of the body and close at the top, right? And the wicks are always the same. The very tip of the top wick is the high, and the bottom of the lower wick is the low. And for a red bearish candle, you probably guessed it, it's the exact opposite. Because the price went down, it opened at the top of the body and closed at the bottom. The wicks, though, still mean the exact same thing. The tip top of the upper wick is always the highest price reached, and the very bottom of the lower wick is always the lowest price. Okay, this next part is really important to grasp. A candle isn't just a static picture. It's the final snapshot of a story, a little battle between buyers and sellers that unfolded over its time period. Let's actually walk through how one gets made. So imagine a new 5-minute candle just begins. Boom, the price opens. It immediately drops a bit, so for a moment our candle has a red body. But then, the buyers jump in. They push the price all the way back up past the opening price. Now that old low point becomes a lower wick, and the body has flipped to green. The price keeps going up, hits its peak for the period, that's our high, then pulls back a little, forming a small upper wick. Finally, the 5 minutes are up, and the price closes. And there you have it. The final shape tells that whole story of the back and forth fight. So now that you see how a candle tells a story, let's just wrap up with one special type of candle you'll see, and talk about why this is really the place to start your journey. Every now and then, you'll see a candle that just looks different. It looks kind of like a cross, with a very tiny body or maybe no body at all. That's called a doji, and it happens when the opening price and the closing price are basically the same. This little candle tells a huge story. Total indecision. Neither the buyers nor the sellers could win. It was a draw. Now look, are there other ways to look at price charts? Absolutely. You might hear about line charts or other fancy ones. But here's the bottom line. Candlesticks are the industry standard for a reason. The huge majority of traders use them because of how much information they pack into such a simple visual. So if you're new to this, learning this language is absolutely the best place to start. So there you have it.